Okay, welcome guys. This is chapter 3. We're going to continue with our job order costing discussion and just continue to understand the process of job order costing. So to start this week, we're going to learn some new definitions. We know job order costing is a system used where different products, jobs, or services get produced each period. And so we have a system in place to connect those costs with specific services or products. Absorption costing is a costing method that adds all manufacturing costs, direct materials, direct labor, and both variable and fixed manufacturing overhead into the cost of a product. Another term is the allocation base. Now, we've talked about the activity that is used to assign costs or products. Usually, the allocation base can be direct labor hours or can be machine hours. We know the word, or we've become familiar with the word predetermined overhead rate. That's the rate we use to charge just that manufacturing overhead to jobs that we establish in advance for each period. So we come up with an estimate of what we think the total manufacturing overhead is going to be. We take an estimate of what we expect our allocation base to be. And then we come up with a predetermined overhead rate that we apply to products. You see here, the predetermined overhead rate is equal to the estimated total manufacturing overhead divided by the estimated total amount of the allocation base. We know overhead application is the process of assigning overhead costs to specific jobs. The overhead applied to a particular job is going to be that predetermined overhead rate times whatever the true amount of allocation base is incurred by a job. So if we've got the predetermined overhead rate, and then we'll know exactly how many hours, maybe direct labor hours or direct machine hours, were spent on a job. We'll take those actual hours times that overhead rate that's been predetermined. A normal costing is where the overhead costs are applied to a job by multiplying the predetermined overhead rate by the actual amount of the allocation base incurred by the job. And we saw last week a job cost sheet. It's the form we utilize that transfers over direct materials, direct labor, and the manufacturing overhead that is going to be applied to a job. It's telling me my internet is unstable. Jim, you were right. It's 1 second. Guys, can you hear me?
Yes.
Okay. If it becomes a little unstable or if it gets goofy, will you please let me know and I will switch it onto another one. We are driving home from Georgia. We're at a hotel and the honey, what did you call it? Well, he's got his mic on. We had to switch rooms last night because the location in the hotel wasn't hitting our room, so they put us somewhere else and said it's the best internet in the hotel, and I just see that it's getting a little unstable. Please let me know, okay? Because yeah, that's important to me. Okay, moving on, guys. What we're going to begin talking about is how we flow these costs in this job order costing system. So we're going to see the flow of these costs coming out of the direct materials, or the raw materials, I should say, how we flow them into jobs, how we flow the labor and the overhead into jobs, and ultimately transfer them into finished goods and then cost of goods sold. We're going to use our T account system, which is a great way of showing that flow of the journal entries. Raw materials, we know, are an inventory item. And when they are purchased, they go straight initially into the raw materials subsection of inventory. And as we reconcile them, or we request them, requisition from for a specific job, they will then flow into work in process as we're working on them, the goods. Once those products are completed and ready to be sold, it's at that time they'll go into finished goods. And then once the finished goods have been sold, it's at that time they will no longer be in inventory. It's at that time they will be part of the income statement under the cost of goods manufactured. So, inventory consists of various subcategories. Raw materials inventory are where products, the materials, begin from when they are purchased from the supplier. As we request products or materials for manufacturing, they will then come out of that raw materials category and they will go directly into our work in process inventory. While we are working on products, we will be putting our direct labor for those individuals working directly on products and that manufacturing overhead into that work in process inventory section. Upon completing these products, they will then be transferred out of the work in process inventory subsection and be transferred to another inventory section called finished goods. They stay in finished goods until they are sold. Once those products or goods are sold, it is at that time they are removed from the balance sheet under inventory and are transferred into an expense account, cost of goods sold. At that time, they are no longer a part of the balance sheet. They then become part of the income statement. All of the goods, the raw materials, the direct labor, and the manufacturing overhead will all stay in an asset inventory until they're sold. As you see here, period costs, such as selling and admin, will always hit the income statement. But the product costs will always flow with the goods. And if they're in inventory, they will be an asset. Until they are actually sold, they will stay in the balance sheet. I just want you guys to understand this flow, really important. It does not get expensed until it's sold. So to look at how this works, we're going to take Ruger's Corporation. We're going to take these transactions for the month of April. It produces gold and silver commemorative medallions, and it worked on 2 jobs in April. Job A was a special minting of 1,000 gold medallions commemorating the invention of motion pictures, which started during March and completed in April. Okay, so we know if it's saying it started in March and it was completed in April, we know at the end of the month of March, these goods were still sitting in work in process as an inventory asset. As of March 31st, Job A had assigned $30,000 in manufacturing costs, which corresponds with Ruger's work in process balance on April 1st of $30,000. Then there's Job B. That was an order for 10,000 silver medallions commemorating the fall of the Berlin Wall, which started in April and was incomplete at the end of the month. Excuse me, honey. So we've got 2 jobs that were going on in April. As you see here, the raw materials that came out in March will go from the raw material inventory account and will be credited from the asset raw materials, which is an inventory account, and will be transferred to work in process. Still an inventory account, but it's showing we have removed those from one sub account of inventory and put them into another work in process. Those items have been directly associated with a job we're working on. Okay, now there will be some raw materials that aren't directly related to a particular job that will possibly be transferred into manufacturing overhead. They're needed, but they're not associated specifically earmarked for a job. So those items are going to all go into another inventory account that we call manufacturing overhead. So throughout the month, we've got items flowing into work in process, which is specific jobs. We'll also have items flowing into another sub account that we call manufacturing overhead. Again, we lump a lot into manufacturing overhead because they are costs, but they're not directly associated, or that we can't pick specifically for a particular job. Purchase of raw materials as we relate to within a journal entry format will show when we purchase them, we show a debit to raw materials and we credit accounts payable. Okay, so this is just showing the purchase of raw materials for the company. We'll debit our raw materials and we credit our payable. Then we will, during April, when materials are requested, we will withdraw raw materials. In this particular situation, 52,000 raw materials, and we'll transfer them Some are going directly into our jobs. Some will be transferred into manufacturing overhead. Okay. This is the journal entry to show transferring products, okay, into either the account work in process or the account manufacturing overhead. Okay. So again, the journal entry for the requisition of product would be, we credit that raw materials of the whole amount. Some of it's going into the work in process, some's going directly into just manufacturing overhead. Then, as we are paying wages, we're paying different kinds of wages here. Some go directly to jobs we're working on, and that can be identified to specific jobs that will go into work in process. That labor that's not, quote, direct, of course, flows into manufacturing overhead. So many items, guys, get thrown into manufacturing overhead. That's why it's so important for us to come up with an accurate predetermined rate. But this just shows that those costs, labor, the direct labor goes into work in process, the indirect labor into manufacturing overhead. So in April, employee time tickets included $60,000 recorded for direct labor, $15,000 is recorded for indirect labor. So we show our debit to 60 going for direct products. The indirect labor is going to be debited straight into manufacturing overhead. And we credit our payable because they've not been paid out yet. So we've got, as you can see, the various T accounts where the various costs are flowing. Okay. Now assume that Ruger Corporation incurred the following general factory costs during April. We've got utilities that cover the whole factory, not specific jobs. We've got rent, and we've got some miscellaneous factory overhead. So 21,000 plus 16 plus 3, 16, we've got $40,000 that are going to our actual costs, but we need to record them somewhere. They're going into manufacturing overhead because they are not directly associated with products. Therefore, that's why they are not going into work in process. They're overall manufacturing costs. Okay. So you see, our salaries, we apply specifically to work in process or specifically to manufacturing overhead. Our work in process has our direct materials, of course, our direct labor, but then to take all of these manufacturing overhead costs that there's a lot of, but that continue to happen. We don't know what they're actually going to be. That's why we come up with a predetermined overhead rate. And we then apply them to our work in process. So as the actual costs are coming in, we debit that to manufacturing overhead. But in the meantime, we've got these jobs are happening and going out the door. So we also need to assign these costs the best we know, which is by taking that predetermined rate times whatever driver there is at the actual hours. And so that overhead applied, we credit to the manufacturing overhead and we debit it to our work in process. Now, guys, the actual manufacturing overhead and the applied manufacturing overhead will probably never, ever be equal. So we're gonna either over apply or under apply every year or every month. So if the actual and applied aren't equal, which they won't be, we're gonna have to do a year-end adjustment at the end of the year. So we actually make it balance. Thanks. Okay. Is this making sense so far, guys? Are you getting this? Yes, no?
Yeah, I'd say.
So far, I'd say
Oops, sorry. Assume that Ruger Corporation's predetermined overhead rate is $6 per machine hour. Also assume that during April, 10,000 machine hours were worked on job A and 5,000 machine hours were worked on job B. So 90,000 in overhead costs, which is the $6 predetermined rate times actual hours of 15,000 machine hours, means we applied $90,000 to various overhead costs. We would debit our work in process for the 90. Remember, when we apply manufacturing overhead, we credit that to the manufacturing overhead account. Okay? So that way, we're taking that manufacturing overhead and assigning it to jobs. Non-manufacturing costs are put right into the income statement. Salaries, expenses of employees working in marketing, selling, and admin don't go through inventory. They go right to the income statement and get expensed along with advertising. Those are called non-manufacturing costs. So you see, when Ruger incurs 30,000 in selling and admin, it just goes right to the expense account. Depreciation on office equipment, right to the expense account. Advertising, and an expense. Now, guys, if it was depreciation on factory equipment, that would go into manufacturing overhead. Okay? But these are non-manufacturing costs. So once a job is finished, we're going to transfer it out of work in process, and we're going to debit it to inventory called finished goods. Again, these are all inventory accounts. They're just sub-accounts of the big asset inventory. Job A was completed during April, and job B was incomplete at the end of the month. So the following entry transfers the cost of job A from work in process to finished goods. Since job B wasn't completed by the end of the month, its costs stay in work in process and will carry over to finished goods the next month. So you see, at the end of April, the cost accumulated for job B would remain in the asset account work in process. When the goods are finally sold, it's at that time we will credit our cost of goods sold, and we credit our finished goods, and at that time we debit our expense account cost of goods sold. Or I should say our income statement account. So for Ruger Corporation, we assume 750 of the 1,000 gold medallions in job A were shipped to customers at the end of the month for total sales revenue of 225,000. Because 1,000 were produced and only 750 were sold, we can figure out how much we will assign for a product cost per unit. So we will still have some of this job A sitting in finished goods inventory. But we know 750 items at a product cost of 158 per unit will be transferred out of finished goods into cost of goods sold. We know whenever we sell products, we're going to have two journal entries. One to show the sale, another to adjust our inventory. Okay. So here's an exercise that we're going to understand the flow of the journal entries. Here are the following transactions that occurred in October. Prepare journal entries to record these transactions, and then we'll also prepare a T account so we can see how this flow occurs. It's letting us know that work in process began a balance of 42,000 into that account. So the first one was raw materials were purchased on account. We debit our raw materials. We credit our accounts payable. They always go straight into the raw materials inventory asset account. When raw materials are used in production, generally a requisition order will happen, a request, where we will transfer them from the asset raw materials, so that will be credited, and then our work in process will occur. So you see here in B, raw materials used in production, 190,000, but 178 were sent to direct materials, were directly used for jobs, and 12,000 is indirect. Any indirect materials we know go right into manufacturing overhead. So you see we debited two inventory accounts, the work in process and the manufacturing overhead, and we credited our raw materials. Then we have accrued direct labor and indirect labor. Our direct labor goes into work in process. Our indirect labor goes into manufacturing overhead. And we credit our salaries and wages payable because it tells us that we've accrued these direct labor costs. If it said we paid the direct labor costs, it would be cash. Depreciation recorded on factory equipment, 40,000. We debit our manufacturing overhead and we credit our accumulated depreciation. E tells us other manufacturing overhead accrued during October, 70,000. We debit our 70,000 manufacturing overhead. Here we're going to credit our accounts payable because it tells us it was accrued. Again, if it said it was paid, we would have been crediting cash. F, the company applies manufacturing overhead to costs, manufacturing overhead cost to production using the predetermined rate of $8 machine hour. 30,000 machine hours were used, so we will debit to work in process 30,000 hours times $8 an hour, 240,000. We will credit manufacturing overhead of 240. Guys, remember, when we bring in actual costs to manufacturing overhead, we debit it. When we assign manufacturing overhead to products, we credit it. The applied is always credited from manufacturing overhead. Jobs costing 520,000 according to their job cost sheets were completed during October and transferred to finished goods. So we know debit our finished goods of 520, credit our work in process 520. Jobs that it cost 480,000 to complete according to their job cost sheets were shipped to customers during the month. These jobs were sold on account at 25% above cost. So it's telling us what the sales revenue is. Okay, so we need to remove them from our finished goods and bring them to our cost of goods account. That's our debit of cost of goods because they've been sold. We credit our finished goods. And then remember, you always have to have two transactions here. We show a debit to the receivable of 600,000 because it's 480 times 125%. Or 600,000, and we credit our sales. If it said we received cash for the goods sold, we would debit our cash and credit our sales, but that's not the case here. Any questions so far, guys? Making sense? Now, here you see the T accounts for manufacturing overhead and for work in process. You see the manufacturing overhead. We've got actual costs going into manufacturing overhead, the 12, the 110, the 40, and the 70, 232, right? 232,000. You see what we applied for manufacturing overhead is 240,000. So we've over applied overhead of 8,000. We have a credit balance sitting in our manufacturing overhead, meaning we have a credit balance of 8,000. We've over applied our overhead to the various jobs. Technically, we've charged those jobs more than we actually have spent. Now the work in process, 240, 270, 360, 402, and the 178, 402, 178. We've got, we started with the balance in work in process. Then it told us exactly what was sold, the 520,000. So as a result, the balance sitting in work in process at the end of this is 30,000. Okay. We had a beginning balance. We need to take into account for that. And then we have a debit ending balance of work in process, just because there's goods still sitting that, the work in process. These are goods that have been completed during the month. Some goods are still being worked on. 520,000 were completed and transferred into finished goods. Dillon Products manufactures various machine parts to customer specifications. The company uses a job order costing system and applies overhead costs to jobs on the basis of machine hours. At the beginning of the year, the company used a cost formula to estimate it would incur $4,800,000 in manufacturing overhead cost at an activity level of 240,000 machine hours. Gives us all these different transactions that we will prepare, transfer them to T accounts, and then they're asking if 10,000 of the custom made machined parts are shipped to the customer in February, how much of this job's cost will be included in cost of goods sold for February. So our various journal entries, if we start here, raw materials purchased on account, debit the raw materials, credit our payable. The raw materials used in production will transfer some straight into work in process, some go straight into manufacturing overhead. They all get credited from raw materials. The labor, they tell us exactly what's direct and indirect. Direct goes into work in process. Indirect labor goes into manufacturing overhead. And we credit our wages and salaries payable. Depreciation on manufacturing equipment goes into manufacturing overhead. Let's look at what E says. E says other manufacturing costs are $62,000. We debit our manufacturing overhead here and credit our payable. Then it says we applied. F is applying manufacturing overhead. Manufacturing overhead was applied to production costs on the basis of 15,000 machine hours actually worked during the month. Okay, so we know how we would determine our predetermined rate is our 4,800,000 of estimated manufacturing costs. Divide that by 240,000 machine hours, gives us, is it $20 an hour? Take that by our 15,000 machine hours is how we come up with our work in process. Debit of 300,000. This is applying our manufacturing overhead, credit manufacturing overhead. Okay. Again, how do we determine that overhead rate? 4,800,000 divided by our estimated machine hours comes up with our estimated machine hour predetermined rate, and we multiply that times the actual hours. So then to take those journal entries and post them to the accounts, we're posting the ones that go into manufacturing overhead and the ones that go into work in process. The cost of the completed job is $592,000. It's done. We're going to debit finished goods, credit our work in process because we have finished the job. It's no longer work in process. It's finished. Okay. If 10,000 of the custom-made machined parts are shipped to the customers in February, how much of this job's cost will be included in the cost of goods sold for February? Well, if we produced 16,000 units, but we are selling 10,000, we take all the cost of 592 that was transferred to finished goods, divide that by the number of goods, units, for 16,000 to come up with a cost per unit. That cost per unit times the number we sold, 10,000, means 370,000 will be transferred from finished goods into cost of goods sold. Now, preparing these schedules, we're going to look at a cost of goods sold, cost of goods manufactured. And then we'll look at a cost of goods sold schedule. These will be broken down by direct materials, direct labor, and manufacturing overhead. You'll see we'll show the flow of raw materials and direct labor that's going to be put into work in process, and then what's getting applied to production, the manufacturing overhead. We'll also see the manufacturing costs that are linked with the goods that were finished during the period. So again, we take the raw materials, and the way we break them down, we've got a beginning balance. We add purchases. The beginning balance plus the purchases are what's available. The raw materials available minus our ending inventory is what's sent into production. We know, excuse me, that amount, the raw materials used into production, gets transferred over into manufacturing costs. Direct labor that's used in production and into manufacturing overhead get added to direct materials to arrive at total manufacturing costs. The manufacturing costs get added to the beginning work in process to arrive at total work in process. The ending work in process inventory is deducted from the total work in process for the period to determine what's actually been manufactured for the period. Now, the cost of goods manufactured gets added to the beginning finished goods inventory to arrive at cost of goods available for sale. The ending finished goods inventory is deducted from this figure to figure out what was actually sold. Okay. It's a flow from one inventory account through. So guys, who wants to take this one? Beginning raw materials inventory was 32,000. During the month, 276,000 of raw materials is purchased. A count at the end of the month revealed that 28,000 of raw materials was still present. So what was used, what cost of the direct materials was used during the period? Someone can just blurt it out.
I got C, 280,000, and I could explain my answering if you'd like.
Anyone else? You go. Awesome. What we began with, plus our purchases, is what's available. Less our ending inventory is what we know got transferred into production. How about this one? Materials used in production totaled 280,000. Direct labor is 375, and 180 of manufacturing overhead was added to production for the month. What were the total manufacturing costs incurred for the month? direct materials, direct labor, and manufacturing overhead. Makes sense, doesn't it? Remember, manufacturing costs incurred for the month here are not going to include actual manufacturing overhead. It will only include what we apply from manufacturing overhead. Okay. Beginning work in process is 125,000. Manufacturing costs added to production for the month were 835. There were 200,000 of partially finished goods remaining in work in process inventory at the end of the month. What was the cost of goods manufactured during the month? We take our beginning work in process, add the manufacturing costs added to show total work in process during the period. If we subtract our ending inventory still sitting in there, we show cost of goods manufactured to be 760. Beginning finished goods inventories 130. We added 760. The ending finished good inventories 150. So what was sold? $740. The key here, guys, is to have separate notes showing these formulas. So we're going to look at this exercise and compute our schedules. Okay. The following data from the completed year are shown for Mason Company. So it gives us direct labor cost, raw material purchases and selling expenses and admin expenses, and manufacturing overhead applied to work in process, and actual manufacturing overhead costs, and our inventories. Now, right away, I'm going to tell you, administrative expenses are not going to be a part of our cost of goods manufactured or cost of goods sold schedules. That goes straight to the income statement. Gives us our beginning and ending balances for raw materials, for work in process, and for finished goods. Prepare a schedule of cost of goods manufactured, and then prepare a schedule of cost of goods sold. Assume the company's under or over applied overhead is close to cost of goods sold, and then prepare an income statement. So what we do is we start with our beginning balance of work in process. It gives it to us. The direct materials that flow into our work in process are determined by figuring out our beginning inventory, adding our purchases, showing what's available, less our ending inventory. The difference has to go into materials used in production. We've got our direct labor. We've got our manufacturing overhead applied, which gives us our manufacturing overhead costs that got added into work in process. If we know our ending balance in work in process is 5,000. Then we know through the year, through the month, we manufactured 275,000. Again, guys, the key is to know the details of these statements. The cost of goods sold, again, it gives us our beginning finished goods. We add what we manufactured. Then the two combined gives us our available for sale. Plus our finished goods gives us our cost of goods sold. Now here's the key. We need to figure out, did we over apply or did we under apply overhead? It told us our actual manufacturing costs were 80. It told us that back here. Actual manufacturing costs were 80, but do you see how it told us we applied to work in process 90? Which means here we over applied, didn't we? We over applied our manufacturing overhead, so we overdid it by 10,000. Since we over applied by 10, our real cost of goods sold is 250. No, it's here where we're going to adjust our over applied or our under applied overhead. Okay. Our income statement, sales, which was given to us, less our cost of goods sold gives us our margin. Then we've got our selling and admin expenses that go straight to the income statement. Gives us our net operating income. It seems like a lot, guys, but if you break it down by statement, it's just so logical here. Now how do we compute the over or under applied? Pretty simple. The difference between the overhead cost and the actual is going to either be over applied or under applied. It's going to be under applied if the overhead applied to jobs is less than the total actual cost during the period. If it's under applied, we're going to add that difference to cost of goods sold. If it's over applied, it's because what we applied during the period is greater than what we actually incurred. So Pear Company's actual overhead was 650, but Pear's and the actual costs or labor hours were 170,000 hours. If we know the predetermined rate of 4, we know that we can figure out did we over apply it or under? If we applied 170,000 labor hours at $4 an hour, then we applied 680. If the actual costs were 650, we overdid it by 30,000. We over applied. Okay, so if we over applied, we will subtract 30,000 from our cost of goods sold. So in this case, it's giving us actual manufacturing overhead of 1,210,000. And then it's telling us we had overhead predetermined at 4 times hours of 290,000. So we applied 1,160,000. Our actual was 1,210,000. We under applied it by 50,000. So what we need to do, we need to balance it out. The way we balance it is close it out to cost of goods sold, or we can also apportion it to the various accounts that are happening, work in process, finished goods, and cost of goods sold, based on the percentages. So that 30,000 that we over applied, we would debit our manufacturing overhead because of the over applied and credit our cost of goods sold, which ultimately reduces the actual cost of goods sold. Let's assume this overhead applied in ending work in process, ending finished goods, inventory, and cost of goods sold is 68, 204, and 408 for 680. Then what they want us to do, they want us to prorate that excess accordingly. So what we would do is we would come up with the percentage, the weighted percentage. If we had 68 sitting in the WIP inventory, it's 10% of the whole. If we had 204,000 sitting in finished goods, it's 30% of the whole. And what was sold would be 60% of the whole. So then we could take that 30,000 and apply it to those three various accounts proratably. So you see here, we would debit our manufacturing overhead and we could credit those three accounts to adjust the fact we over applied. Okay. It's more accurate, but it's more complicated, but it's definitely more accurate to do. What effect will the over applied overhead have on net income? Well, it's going to increase net income, won't it? Because we overkilled initially, therefore we'll adjust it by showing our cost of goods sold wasn't as much as we initially thought it was. So again, by under or over applying, in this case, we had a rate of 18.20 per direct labor hour. So we estimated 12,000 labor hours with 218,000, but we actually had 215,000 costs, but less hours. So we have to figure out, did we under apply or over apply? So if we take our 1820 times 11,500 hours, we've got 209,300 that we've applied. If our overhead costs were really 215,000, do you see we under applied it by 5,700? Therefore, in this scenario, we would be crediting our manufacturing overhead and debiting those various accounts. You see here, in this case, the difference, I think I'm getting ahead of myself here. In that case, what we showed our cost of goods sold to be are actually greater than what we initially did. Okay. This one shows us Harwood uses a job order costing system with a predetermined rate of $240 per machine hour based on $192 in cost and estimated 80,000 machine hours. But if the company worked 75,000 machine hours, and had these costs. So it gives us the cost, the manufacturing overhead, maintenance, and direct materials, indirect labor, utilities, insurance, and depreciation. We would have applied $2.40 per hour times 75,000 hours, which is 180,000. Okay, that's what got applied. But did you see here that it shows here we underapplied because we have a balance of a debit balance sitting there in our manufacturing overhead of 4,000. So we actually spent 4,000 more in manufacturing overhead than what we applied. So we would debit our cost of goods sold to increase it. So we actually spent 4,000 more than we had initially expected. There's not a better way to do this because the costs flow in after the fact. When overhead is applied using a predetermined rate, it's assumed that the overhead cost is proportional to machine hours. But when the actual machine hours turns out, in this case, to be 75,000, the costing system assumes the overhead rate will be 75,000 times the predetermined rate. This is a drop of 12,000 from the initial estimated manufacturing overhead cost of 192. But why it's goofy is our actual manufacturing overhead costs are really only 184. They dropped 8,000 from what we estimated. Okay. So guys, it's pretty straightforward. Here we're getting into the kind of detail of the various statements, but make sure you take those statements and you write them out so you understand how the products flow. So I think we've covered enough. I mean, I've gone through pretty extensive detail in these exercises that you'll be able to complete your homework. If you have questions, email me, post it to the discussion. Stuart checks the discussion daily. I check it daily. The reason I encourage you to post it is because if you're having a question, other people may be also. Any questions before we end this, guys? How's everyone doing? Everyone doing okay? Well, you guys have a great week. And we will for sure see each other next week. Take care.